Welcome to all who are watching this video. The objective of this video is to help GST registered businesses prepare for the upcoming GST rate change on 1st January 2024. We will start with an introduction of the GST rate change. We will then run through a checklist of what GST registered businesses need to do to prepare for the GST rate change. The four broad areas that we will cover include the accounting software and invoicing system, price display, existing contracts, transitional rules and the GST rate to apply. Next, we will highlight some operational and compliance matters that will be useful for you to know as you prepare your business for the rate change. Finally, we will end the session by going through the GST rate change errors that you should avoid. These errors were made by some businesses when preparing for the last rate change on 1st January 2023. This video will take about 45 minutes. If you are watching this video for the first time, we encourage you to watch it from the start to the end. For repeat users, you may go directly to specific topics that are of interest to you by viewing this video via YouTube and click on the selected topic timestamp found under the video description. First, a brief introduction on the GST rate change that will take effect on 1st January 2024. In the 2022 budget statement, the Minister for Finance announced that GST will be raised from 7% to 8% with effect from 1st January 2023 and 8% to 9% with effect from 1st January 2024. The revenue from the increase in GST will go towards supporting our healthcare expenditure and to take care of our seniors. This video covers the basics of what you need to know and do to be ready for the second rate change on 1st January 2024. To get you ready, IRAS has a list of resources carefully put together to ensure your business is prepared for the GST rate change from 1st January 2024. Our e-text guide on GST rate change is a must-read for all GST registered businesses. After reading the guide, you can supplement your understanding by going through our webpage and FAQs as well. Please scan the QR codes below to access these resources. We will now move on to our second agenda item, the checklist of things that GST registered businesses need to take note of to prepare for the rate change from 8% to 9% on 1st January 2024. These are generally the areas that every GST registered business should work on to get ready for the rate change. You need to update your accounting software and invoicing system, including your cash register and point of sale system to incorporate the new GST rate of 9% effective 1st January 2024. Update your price displays to inform customers of the new GST rate with effect from 1st January 2024. Review existing contracts and understand the rate change transitional rules to ensure correct application of the GST rate for supplies spanning rate change date. If you have an existing accounting software and invoicing system, you should ensure your system can incorporate the new GST rate of 9% from 1st January 2024. Generally, accounting systems should be flexible to accommodate the prevailing GST rates before 1st January 2024 and the new GST rate of 9% on and after 1st January 2024. This is essential as in accordance with the transitional rules for the implementation of the new GST rate, you may still issue invoices based on the preceding rates even though the invoice is issued after the rate change date. Businesses are not allowed to reflect or charge GST at 9% on the invoices and payments that are issued or received before 1st January 2024. We encourage GST registered businesses with existing accounting software and systems to reach out to your vendors early. For GST registered businesses that do not use any accounting software currently, you may wish to procure one to assist you in your GST reporting and to facilitate tax compliance. You can leverage on the Productivity Solutions grant to subsidize some of the costs to acquire the software. Scan the QR codes for the list of approved accounting software and check out your eligibility for the Productivity Solutions grant. Do consider to use an accounting software that will enable you to use our new digital service to file your GST returns seamlessly. There are more than 20 accounting software on the ASR Plus register that will provide you with the convenience to file your GST return with a click of a button. This seamless filing feature allows you to fulfill tax obligations more easily and accurately. You can reduce time needed to file and potential transposition errors since there is no need for manual data entry in My Tax Portal. Enjoy digital record keeping. Reduce your compliance costs. Fulfill other adjacent regulatory obligations from the same software. For example, some software also allows the automatic generation and submission of annual returns and financial statements to IRAS. To find out more about the seamless filing service, please scan the QR code. The second item on the checklist relates to your price display. Price displays to the public must be inclusive of GST. Prior to the GST rate change date, you should prepare your price displays to show the new prices inclusive of 9% GST with effect from 1st January 2024. Price displays include changes to price tags, price lists, advertisements, brochures, websites, and any other places where your prices of services or goods are displayed. On the rate change date, you have to replace the price displays showing the old rate with the price displays showing the new rate. For businesses who may not be able to change the price display overnight, you may display two prices concurrently during the transition period showing prices inclusive of 8% GST applicable before 1st January 2024 and prices inclusive of 9% GST applicable with effect from 1st January 2024. As a concession, hotels and food and beverage businesses that impose a service charge and GST are not required to display GST inclusive prices. However, the price display must have a prominent statement to inform customers that prices are subject to service charge and state the correct GST rate that is to be applied. The concession is not applicable if the hotels and food and beverage businesses do not impose a service charge or levy a nominal service charge without genuine business reasons for doing so. As you amend your price displays to reflect any increases in prices, we would like to remind businesses to be transparent in communicating the reasons for any price or fee increases to the consumers. Businesses should explain the main reasons for the price or fee increase and not misrepresent the situation to consumers by attributing the price increases primarily or solely to the increase in GST. The Committee Against Profiteering takes a serious view of any unjustified price increases using the GST increase as an excuse, and will investigate all feedback on such cases. The third item on the checklist requires GST-registered businesses to review existing contracts to supply goods or services with effect from 1st January 2024. If you have existing contracts, you can increase the contractual consideration to charge GST at 9% unless the contract has explicitly specified that any tax change is excluded or has already been taken into account. If you are not able to revise the consideration due to limitations in the contract terms, you will need to account for GST using the tax fraction 9/109 multiplied by the total consideration. For example, your contract specifies that the total consideration inclusive of GST is $1,000 and any change in consideration is disallowed. If you receive payment and delivered the goods after 1st January 2024, you must account for GST at $82.57 using the tax fraction of 9/109 multiplied by the total consideration of $1,000. If you are unsure whether your contract contains any express exclusion or has taken the tax rate change into account, please consult your lawyer to determine if you can increase the consideration due to the GST rate increase. The last item on the checklist is about understanding and applying the GST rate change transitional rules. We will now go through the content as reflected on this slide for a better understanding of how and when to apply these transitional rules. Let us first recap the general time of supply rule. The time of supply rule is important as it determines when the supply is treated as having occurred for GST purposes. For most transactions, the time of supply will be the earlier of when an invoice is issued or when a payment is received. The GST rate chargeable on the supply will be the prevailing rate at the time of supply. If the time of supply is triggered before 1st January 2024, you have to charge GST at the prevailing rates of 7% for supplies made before 1st January 2023 and 8% for supplies made from 1st January to 31st December 2023. If the time of supply is triggered on or after 1st January 2024, the new GST rate of 9% will apply. However, businesses cannot be guided solely by the general time of supply rule to determine the correct GST rate if supplies span the GST rate change date. You will have to consider rate change transitional rules to determine the correct GST rate to apply. A supply spans the GST rate change date when one or two of the following events take place wholly or partially on or after 1st January 2024. The issuance of invoice, the receipt of payment, the delivery of goods or performance of services. It is important to ascertain when the three events occur for a particular supply to determine the GST rate to apply. You may be required to adjust for the GST rate chargeable on your supplies due to the transitional rules. The transitional rules will apply in the same manner for all types of local supplies, including continuous supplies and reverse charge transactions, as well as imported services under the Overseas Vendor Registration regime. As this video is for businesses at large, we will not cover transitional rules that relate to reverse charge transactions or transitional rules for businesses making supplies under the Overseas Vendor Registration regime. Please refer to the e-text guide on 2024 GST rate change for more information on these rules if they are applicable to your business. The next part of the presentation covers an in-depth application of the transitional rules. As mentioned earlier, transitional rules apply if supplies span the GST rate change date. A supply is considered to span the GST rate change date when one or two of these three events take place wholly or partially on or after 1st January 2024. There is an issuance of invoice, receipt of payment, delivery of goods or performance of services. The application of the rule is best explained starting with the invoice. Businesses may issue an invoice on or after the rate change date or before the rate change date. For each of these situations where an invoice is issued, we need to determine the timing of the other two events, that is, payment and delivery of goods or services, to determine the correct GST rate to apply. Let's start off by considering situations where an invoice is issued on or after 1st January 2024. This flowchart guides us on how to determine the GST rate to apply. Where an invoice is issued on or after the rate change date, depending on when payment is received and whether payment is in full or if it is partial payment, the GST rate to be applied is shown in these boxes as indicated by the red arrows. You will also notice in the flowchart that under certain scenarios, as indicated by the blue arrows, the business has an option to choose whether to consider the value of goods delivered or services performed before the rate change date for the purpose of determining the transaction value and corresponding GST rate to apply. We will now move on to cover each of these limbs in the flowchart in detail. Let's start with the first scenario, where the supplier issues the invoice for the supply of goods or services on or after rate change date and receives full payment before the rate change date. Regardless of when the goods are delivered or services are performed, the supplier is subject to GST at 8% since payment is already received in full before the rate change date. Let's look at the next scenario, where invoice is issued and full payment is received on or after the rate change. The time of supply will be triggered after the rate change. As such, the supplier is subject to GST at 9% unless the supplier chooses to charge at 8% on the value of goods or services completed before the rate change date under scenario 2A or 2C. Now, Let's look at some examples to illustrate the three scenarios in this table. This example illustrates scenario 2A, where the goods are delivered before the rate change date, but invoice and full payment is after the rate change date. According to the general rule, the time of supply for the transaction is triggered after the rate change date, and hence GST shall be charged at 9%. However, under the transitional rules, the supplier can choose to charge GST at 8% on the entire value of the supply if the goods are fully delivered before the rate change date. In this second example, which illustrates scenario 2B, all the three events happen after the rate change date. According to the general rule, the time of supply for the transaction is triggered after the rate change date, hence GST shall be charged at 9%. In this case, the supplier cannot choose to charge GST at 8%. This third example illustrates scenario 2C, where part of the goods are delivered before the rate change date and remaining goods are delivered after the rate change date, while the invoice is issued and full payment received after the rate change date. According to the general rule, the time of supply for the transaction is triggered after the rate change date, and hence GST shall be charged at 9%. However, the supplier can choose to charge GST at 8% on the value of part of the goods delivered before the rate change date, that is $700. The remaining value of the goods delivered after the rate change date, which is $300, will be subject to GST at 9%. There may also be situations where a tax invoice is issued on or after the rate change date, and part of the payment is made before and part made on or after the rate change date. In such case, the prevailing rate at the time of supply shall apply, unless the supplier chooses to charge at 8% GST under scenarios 3A and 3C shown in this table. This option to choose to apply an 8% rate is available only when full or part delivery of goods or performance of services happens before the rate change date. Let's look at some examples to illustrate the three scenarios in this table. In this example, for scenario 3A, the supplier received part payment of $400 before the rate change and $600 after the rate change date. He delivered all the goods before the rate change date, but only issued the invoice after the rate change. According to the general rule, 8% GST is chargeable on $400 received before the rate change date, and 9% GST is chargeable on $600 received after the rate change date. However, under the transitional rules, the supplier can choose to charge GST at 8% on the entire value of the supply, as the goods are fully delivered before the rate change date. Moving on to scenario 3B, the supplier received part payment of $400 before the rate change date, issued the invoice after the rate change, and received the remaining payment of $600 before he delivered the goods to the customer. Under this scenario, according to the general rule, GST shall be charged at 8% on $400 received before the rate change date and 9% on $600 received after the rate change date. The supplier cannot choose to charge 8% GST on the remaining value of $600. Lastly, for scenario 3C, the supplier received part payment and delivered part of the goods before the rate change date. The remaining payment is received and goods delivered after the rate change date. According to the general time of supply rule, GST shall be charged at 8% on $350 received before the rate change date and 9% on $650 for the remaining value of the goods. Since the supplier has received part payment and delivered part of the goods before the rate change, he can choose to charge GST at 8% on the higher value of goods delivered or payments received before the rate change. In this case, he can select to charge 8% GST on $600, which is the higher value, and charge 9% GST on the remaining value of $400. Let me now cover some important points to take note of when you choose to apply the 8% rate under the transitional rules. If you have issued a tax invoice or simplified tax invoice on or after the rate change date with 9% GST, and now choose to charge 8% GST on the supply of goods delivered or services performed before 1st January 2024, you must issue a credit note to your customer by 15 January 2024 for the GST amount overcharged, or cancel the original tax invoice and at the same time reissue a new tax invoice to charge GST at 8%. If you are unable to make the adjustments by 15 January 2024, you are given up to 90 days from when the original tax invoice is issued to adjust the transaction. However, should your customer request you to issue the credit note or new tax invoice earlier before the expiry of the 90 days, you are required to do so earlier. There is no need to complete any form or seek prior approval from the Comptroller of GST for applying the lower GST rate of 8% if you satisfy the conditions explained in the earlier scenarios. However, you must maintain documentary evidence such as the delivery order or certification of work done, customer's acknowledgement, or other commercial documents used by the business to show that goods have been delivered or services have been performed before the rate change date, and furnish these documents to IRAS upon request. We would also like to highlight that only the supplier can choose to charge GST at 8% if they satisfy the conditions under the transitional rules. Hence, if you are a customer who issues tax invoices under an approved self-billing arrangement, you must seek the supplier's consent in writing before choosing to apply the lower GST rate under the transitional rules. Let's now move on to the rules to consider to determine the correct GST rate to apply when an invoice is issued in 2023. This flowchart guides us to determine the GST rate to apply. For these scenarios, as the invoice is issued before the GST rate change date, there may be a need for you to make adjustments to the invoices when applying the transitional rules. If the payment is received in full before the GST rate change date, as illustrated by the red arrow, GST is chargeable at 8% and no adjustment is required. However, if the payment is not received in full before the rate change date, as illustrated by the blue arrows, we have to ascertain the date of delivery of goods or performance of services to determine whether there is a need to adjust the GST rate chargeable and issue a credit note and new invoice. We will now move on to cover each of these scenarios in the flowchart in detail. So first, under this scenario, where the supplier issues an invoice and receives full payment before the rate change date, the full supply is subject to GST at 8% and no adjustment is required regardless of when the goods are delivered or services are performed. Next, we move on to a scenario where the invoice is issued before the rate change, but payment is received in full after the rate change date. Based on the general time of supply rule, as the invoice is issued before the rate change date, the supplier would have to charge 8% GST on the supply. However, as the payment was only received after the rate change date, the supplier has to ascertain whether the goods are delivered or services performed before the rate change date to determine whether he needs to revise the tax invoice and adjust the GST rate accordingly. In this table, there is no need to make any adjustment if the goods are delivered or services are performed in full before the rate change date. However, for scenarios 5B and 5C, the supplier would need to adjust the GST charged as not all the goods or services are performed before the rate change date. We will illustrate with an example for each of these scenarios in the following slides. To illustrate scenario 5A, this example shows a transaction where the invoice is issued and goods delivered before rate change date, but the payment is only received after the rate change date. When the invoice is issued, the supplier must charge 8% GST on the supply. As the goods are fully delivered before the rate change date, no adjustment to the tax rate is required. Now for scenario 5B, this involves a transaction where invoice is issued before the rate change, but the payment is received after the rate change date and services performed after the receipt of payment. In this scenario, the supplier must charge 8% GST on the supply when he issued the invoice before the rate change date. As no payment was received and no services were performed before 1st January 2024, under the transitional rules, the supplier is required to issue a credit note to cancel the original tax invoice and issue a new tax invoice to charge GST at 9% by 15 January 2024. If you need more time to do the GST adjustments, as a concession, you are given up to 31st of March 2024 to do so. Let's take a look at an example under Scenario 5C, where the tax invoice is issued and part of the goods are delivered before the rate change date. The payment is received and remaining part of the goods is delivered after the rate change date. Similarly, the supplier must charge 8% GST on the supply, that is $80, when he issues the tax invoice. As only part of the goods are delivered and payment is not received before the rate change date, the supplier has to make an adjustment to charge 9% GST on the part of the goods delivered after the GST rate change date. In this case, the supplier is required to issue a credit note for $324 comprising $300 of the selling price plus 8% GST of $24 and issue a new tax invoice for $327, which is based on the selling price of $300 plus 9% GST amounting to $27. This must be completed by 15 January 2024. We will now move on to explain the transitional rules applicable if a tax invoice is issued and partial payment is received before the rate change date. Based on the general time on supply rule, as the invoice is issued before the rate change date, the supplier would have to charge 8% GST on the supply. There is no need to make any adjustment if all the goods are delivered or the services are performed in full before the rate change date as indicated under Scenario 6A in the table. However, for Scenario 6B and 6C, the supplier will need to adjust the GST charged as full payment is not received and the supplier has not delivered all the goods or performed the services in full before the rate change date. Let's look at some examples to illustrate the three scenarios in this table. In Scenario 6A, the tax invoice is issued and goods delivered before the rate change, but payment straddles the rate change date. In this example, the supplier must charge and account for GST at 8% on the tax invoice issued to the customer before the rate change date. As the goods are fully delivered before rate change, no adjustment is required. In Scenario 6B, the invoice is issued before the GST rate change and only part payment of $400 is received before the rate change date. The remaining payment is received after the rate change date and goods are delivered thereafter. Similarly, the supplier must charge and account for GST at 8% on the tax invoice issued to the customer before the rate change date. As the goods were not delivered before the rate change, and the supplier only received part of the payment, that is $400, before the rate change date, under the transitional rules, the supplier is required to charge 9% GST on $600 on the part payment received after the rate change date. In this case, the supplier needs to issue a credit note for $648, being $600 plus 8% GST of $48, and issue a new tax invoice for $654, which comprise $600 of the sales price plus 9% GST amounting to $54. This should be completed by 15 January 2024. In the last scenario, both the payment and delivery of goods straddle the rate change date. In this example, the supplier delivered part of the goods of $600 and received part payment of $350 before the rate change. When the supplier issues the tax invoice before the rate change date, he must charge 8% GST on the supply. Subsequent to the issuance of the invoice, the supplier only received part of the payment and delivered part of the goods before the rate change date. Under the transitional rules, 9% GST is chargeable on $400 of the part of the goods delivered after rate change, being the lower value of payments received or goods delivered after the rate change date. The supplier is thus required to issue a credit note for $432, comprising $400 of the sales price plus 8% GST amounting to $32, and issue a new tax invoice for $436, which is $400 plus 9% GST amounting to $36. This is to be completed by 15 January 2024. We have just covered the scenarios where a supplier may need to make adjustments to the invoice. Let me now share on when to report the output tax adjustments in the GST return. The GST rate change does not affect the way you complete your GST return. Where your standard rated supplies of goods or services are subject to adjustments due to the GST rate change, you should report the adjustments in your GST return for the period in which the adjustment is made, or in accordance with the transitional rules for rate change where relevant. There is no separate form or return to submit for supplies spanning the date of rate change. Let me illustrate this with an example. Suppliers' prescribed accounting periods are for the periods ended March, June, September, and December, and so the supplier files GST returns on a quarterly basis. The supplier issued a tax invoice for $1,000 and charged 8% GST on 9 December 2023. As the supplier did not receive any payment, nor did the supplier perform any service before 1 January 2024, the supplier is required to issue a credit note and a new tax invoice by 15 January 2024. In the GST return for period ended 31st December 2023, the supplier would have issued an original tax invoice of $1,000. This would increase the value of the standard rated supplies by $1,000 and increase the output tax by $80 for that period. In the GST return for the period ended 31st March 2024, the supplier should issue a credit note to reduce the value of the supply by $1,000 and reduce the output tax by $80. The supplier should issue a new tax invoice to increase the value of standard rated supplies by $1,000 and increase the output tax by $90. The net adjustment for this period would be an increase of output tax by $10. In the earlier part of this presentation, we have spoken extensively about the date of payment. Just a reminder that for GST purposes, the date of payment is the date when payment is received. There are some exceptions to this rule of determining the date of payment. Do refer to this slide to determine when payment can be treated as received before 1 January 2024, despite the fact that the funds are received in 2024. If you are a merchant making supplies through an intermediary, for example, online or booking platform, the intermediary may receive payment from the customer before subsequently remitting the payment to you at a later date. In such cases, you may treat the payment as received before 1 January 2024, provided that you are able to determine that the conditions under the various payment modes mentioned here are met. We will now move on to highlight other operational and compliance matters that GST-registered businesses should take note of. We will cover the topics as listed on this slide. Just a recap, when covering the transitional rules in this presentation, I shared that for the supply of goods and services straddling rate change, the supplier may apportion the value of goods or services that is supplied before and after the rate change date. To apportion the value of the transaction, the supplier may do so using appropriate methods such as valuation of measurable work or based on the business normal costing or pricing system. For example, you contract to deliver 100 boxes of homogeneous goods to your customer for $1,000 and you delivered 30 boxes in 2023 before rate change date and 70 boxes after the rate change date. You should use the quantity of goods delivered to apportion the value of goods supplied before and after the rate change, as shown in the example here. If you are supplying services, you can use the number of days or months as a proxy to apportion the value of services performed. For example, you provide 3 months cleaning services to your customer for $6,000, and the provision of services is spread evenly across the 3 months. You can use the number of months to apportion the value of services performed before and after the rate change, as shown in the example here. Sometimes, businesses may offer volume-related rebates in the form of cash to the customers when they reach a minimum purchase amount. This is equivalent to a discount given for past purchases. Generally, a credit note is issued to the customer to reduce the selling price and the GST amount. Now, if the goods are supplied to your customer before 1st January 2024, but you are only giving the rebates after 1st January 2024, do take note of the GST rates that will need to be applied to adjust for the rebates given by referring to the table shown here. If you are giving a rebate to offset future sales which takes place after 1st January 2024, you should charge and account for GST at 9% on the net value of the next sales after deducting the rebate. It is not uncommon for goods to be returned to a business or exchanged for new ones. If goods are returned to you in 2024 and you had supplied the returned goods to your customer before 1st January 2024, GST should be adjusted based on the GST rate originally charged. For example, if the goods were supplied with GST charged at 8%, you should adjust GST for the returned goods at 8%. Please maintain documentary evidence such as your original invoice and delivery note to show whether the returned goods were supplied before, on, or after the rate change date. If you have supplied goods before 1st January 2024 and agree to provide an exchange of goods on or after 1st January 2024, GST is chargeable at 9% on the additional consideration received, provided you do not refund the consideration received for the original goods. If you provide a refund in cash or store credit, which is then utilized to make payment for other goods or services on or after 1st January 2024, GST is chargeable at 9% on the full amount on the new goods or services. When you use your business goods or assets for private purpose, or make them available to any person for use other than for a purpose of your business without receiving any payment in return, this is deemed as a supply of service if you have been allowed input tax on these business goods. The time of supply for the deemed supply, that is when output tax should be accounted, is the last day of the prescribed accounting period in which the goods are used or made available for use. If the goods are used or made available for private or non-business use before 1st January 2024, but the last day of the prescribed accounting period falls on or after 1st January 2024, you are required to account for output tax at 9% on the full cost of providing the services, as the supply is treated as taking place after the rate change date. However, the transitional rules allow you to account for deemed output tax at 8% on the extent of goods put to private use before 1st January 2024, provided you maintain documentary evidence on period of use for the goods or assets. Say, for example, your business allows your related company to use the company's factory for free during the month of December 2023. If you have been allowed input tax claims on the purchase of the factory, you will need to deem output tax on the annual value of the property for 1 month at the last day of your prescribed accounting period. And if you are under the accounting period covering 1st November 2023 to 31st January 2024, or 1st December 2023 to 29th February 2024, your last day of the prescribed accounting period is after the rate change date. Under the transitional rules, you can choose to account for GST at 8% for the property put to private use for December 2023, provided you maintain documents showing the period of use. Some businesses may operate at midnight and into the early hours of the morning on the eve of the rate change date. For such businesses, GST may be charged at the old rate of 8% for sales made between midnight to 7 AM on 1st January 2024, provided it is their normal accounting practice to treat the sales made after midnight as sales of the preceding day, and the cash registers and accounting systems are programmed in this way. Businesses may issue or receive simplified tax invoices from its supplier if the total transaction amount inclusive of GST does not exceed $1,000. For the purpose of GST, there is no need to indicate the GST amount separately on the simplified invoice. It is sufficient to just indicate that the amount of the invoice is a GST inclusive price. There are exceptions to the general rule. As explained earlier, under the transitional rules, businesses may choose to charge GST at 8%. In such cases, the business must show the GST amount or GST rates separately on the simplified tax invoice so that it is clear to the customer that GST is charged at 8%. If due to the application of the transitional rules, the business applies different GST rates on the goods supplied, the business should issue a tax invoice instead of a simplified tax invoice to show the different GST rates and corresponding GST amounts. Now, if you're receiving a simplified tax invoice as a customer, you need to know the GST amount incurred if you want to claim the input tax. If the GST amount is not shown on the simplified tax invoice, apply the tax fraction based on the prevailing GST rate to compute the GST amount claimable. For example, if the simplified invoice is issued in 2023, you should use the tax fraction of 8/108 to claim the input tax incurred. Or if the simplified invoice is dated on or after 1st January 2024, you should use the tax fraction of 9/109 to claim the input tax. In the last section of this video, we would like to run through the GST rate change errors that you should avoid. These errors were made by some GST registered businesses when preparing for the last rate change on 1st January 2023. You should not charge GST at 9% before 1st January 2024. For example, if you receive payments before 1st January 2024, you should charge GST at 8%, even though the goods or services are to be delivered after 1st January 2024. You are also advised to ensure your systems apply the correct GST rate. The 9% GST rate should be charged only with effect from 1st January 2024 and not earlier. Next, you should also not charge nor display GST at all rate of 8% after 1st January 2024. If you have multiple sales channels such as mobile apps, self-ordering kiosks, physical outlets, and online websites, please ensure that all receipts or invoices issued are updated to charge 9% GST from 1st January 2024. Your price display for all sales channels should also be updated to 9% GST from 1st January 2024. If you intend to absorb the additional 1% GST, please ensure that the receipts or invoices issued and price displays from 1st January 2024 reflect the new GST rate of 9%. Finally, please check that the correct GST rate is reflected on your receipts and invoices when you are testing your accounting and invoicing systems, cash register, or receiving systems for point of sales billing, and when you issue the receipts and invoices. This will ensure you avoid the error of reflecting the wrong GST rate on receipts and invoices, even though the GST amount is computed correctly. We have come to the end of the video. To recap, here are the resources that you may refer to implement the GST rate change seamlessly. We would like to remind all GST registered businesses to start preparing early. Thank you.